Welcome back to the vlog. Today we are going to be picking up exactly where we left off the last time. We're going to be jumping into chapter 2 of this book here, Day Trading by Justin K. But yeah, so we'll jump right into that. Let me set you guys down and we'll get going. Okay, chapter 2, The Truth About Trading. The day trading industry, riddled with promises of wild success as well as dire warnings of failure, make it difficult for beginners to evaluate objectively. As always, the reality lies somewhere in between, and aspiring traders should carefully weigh the benefits and risks involved before jumping headfirst into the market. In this section, we explore the truth about trading and discuss what to expect when getting started in the industry. So why trade? There are few professions in the world that offer unlimited financial potential, flexible working hours, and constant intellectual stimulation. With the advent of the internet and the liberalization of financial markets, anybody can now trade stocks, bonds, futures, currencies, and countless other assets from anywhere in the world. New day traders can start out with little more than a small starting capital, a working internet connection, and a brokerage account. Experienced day traders can make six figures income just by working relatively few hours every day and without having to leave the house. The combination of low barriers to entry and high earnings potential is what attracts some of the brightest minds in the world to this industry. A typical day for a retail day trader begins before the market opens. During this time, the day trader screens for potential opportunities by reading the news or looking at statistical indicators. The first half hour after the opening bell is usually the most chaotic. The market typically displays significant volatility during this time as overnight information being digested is being acted on. A day trader can take advantage of stabilizing trends during the mid-mornings when things start to normalize and before larger institutional traders in New York break for lunch. The second wind begins mid-afternoon, when additional opportunities may present themselves on the basis of new information in the forms of news and/or statistical measures. After the market closes, the day trader spends a bit of time catching up on market action and setting reminders to follow up on particular trades during the next trading session. U.S. markets usually open at 9 a.m. and close at 4 p.m. Eastern Time. As such, day traders put in limited hours of work each day. On the West Coast, day traders have even more attractive work hours, which begin around 6 a.m. Pacific Time and around 1 p.m. Pacific Time. These attraction work hours leave the day trader with the rest of the afternoon and night for leisure activities. Why day trade? Most financial experts recommend purchasing long-term investments instead of trying to time the market by day trading. As mentioned earlier in this book, statistics show that over time, active traders tend to generate lower returns than long-term investors. The reason for this phenomenon are unclear, but it could be that most people are not willing to commit the time and capital necessary for learning and mastering a challenging profession like day trading. So why would anyone choose to day trade? As the market produces an average return of only about 8% each year, long-term investing requires either a lot of capital or a long time horizon to pay off. During the first year, someone with a capital of $25,000 might make $6,250, which is hardly enough to sustain a living. An investor would need about $200,000 in the first year in order to make $50,000 income before tax. Of course, these relatively low rates of return are justified for investors purchasing broad market index funds, as they usually do not have to lift a finger in order to make a profit. An annual return of 8% also beats most, if not all, savings account interest rates and other forms of savings or investing capital. In contrast, the day traders attempt to generate higher rates of return by devoting more time and resources to trading. With the same $25,000 in initial capital, day traders may identify trades that return an average of 1%. An average position size of $5,000 would mean that each trade could generate an average of $50 in profit, with many different trades placed each day and every day. In aggregate, these activities could generate much higher returns than long-term investing could. The good news: day trading is a profession that is easy to start but difficult to master. An aspiring day trader needs little more than sufficient starting capital, a brokerage account, and a reliable internet connection to get started. There are also countless resources online for learning about day trading and coming up with ideas. For example, StockCharts.com provides free stock charts and access to hundreds of technical analysis tools. And StockTwits.com provides real-time stock picks suggested by amateurs and professionals who use the website. These are just two of thousands of online tools that help to make day trading easier than ever. Trading itself has also become increasingly accessible over the years. In the past, day traders had to use already outdated information as they placed orders over the phone. Today, the internet brings real-time information to our fingertips and makes placing trades as easy as clicking a button. Automated day trading strategies do not even require pressing a button. Using a set of rules that the day trader specifies beforehand, a computer algorithm can automatically place trades on his behalf. Many aspects of day trading are poised to become even easier for retail day traders as new technology levels the playing field. New analytical tools and trading platforms also promise to make it increasingly easy to develop high-performance trading systems, which could eventually rival many institutional-grade ones. Internet-based. Day trading shifted from an institution-only activity to something accessible to anyone with an internet connection. Over the past several years, the internet has dramatically reduced the cost of doing business by eliminating many unnecessary intermediaries from the process. As a result, commissions and related fees have been reduced significantly, and the market has become much more accessible to day traders. For example, before the 1980s, brokerage commissions were fixed at 1% of the trade amount. In 1975, the SEC made fixed commissions illegal, leading to the rise of discount brokerages. The rise of the internet has put downward pressure on commissions ever since. The availability of the internet in nearly every part of the world has made day trading a very location-agnostic profession. Although many day traders would prefer to have very stable and fast internet connections, they are ultimately free to live nearly anywhere with a connection. Day traders on the extreme of the spectrum have taken up residence in developing countries where the cost of living is low, and they are thus able to day trade full-time. Others may prefer to work from the comfort of their own home rather than worrying about maintaining an office. By connecting billions of people, the internet has made information more accessible for everyone. The lightning speed of internet connectivity means that day traders have access to real-time prices and market-moving information, instead of having to wait to read about developments in the next day's newspaper. Services like the flyonthewall.com, provide real-time news to day traders who can then take advantage of opportunities as soon as they arise. The information gap between institutional and retail day trading is rapidly closing. At the same time, the rise of web-based applications that operate entirely on the internet has dramatically broadened the number of tools available to day traders. From trading system exchanges to stock screening tools, these services provide day traders with an extensive set of instruments at their disposal. The ongoing growth in cyberspace will likely create even more opportunities in the future for day traders. The ubiquity of smartphones make it possible to trade on the go while having access to the same real-time tools and information. In addition to trading, users can use their smartphones to access a growing number of apps that can assist with trading. For instance, StockTwits provides access to real-time ideas and information from anywhere, and Analyst RT provides real-time alerts with analysts releasing new market-moving research reports. Bonuses and incentives. Each year, day traders execute transactions in the order of hundreds or thousands, substantially more than the average individual investor. As a result, day traders are tremendously profitable for brokers, who usually earn a commission on each one of these trades. Brokers work hard to attract day traders by offering them incentives and bonuses ranging from free trades to outright cash, simply for moving over to their accounts. Taking advantage of these bonuses and incentives enables day traders to reduce their trading costs or earn a little extra on top of their trading income. Some of the most common types of incentives include reduced commissions, improved execution speed, enhanced flexibility, higher end trading platforms. For example, a new account with $50,000, a typical promotion might be 60 days worth of free trades and up to $600 in cash. Many brokers also cover any fees incurred when transferring from a prior broker so as to eliminate any extra costs that transfers may impose on the day trader. Often day traders can also request unadvertised discounts and save money in other ways. These unadvertised discounts include reduced commissions over the long term and can add up to significant savings over the course of months or years. In addition to financial benefits, day traders have access to a number of other technological benefits, such as improved trading platforms and faster execution speeds, which provide them with an edge over others in the market. These tools make it easier for day traders to identify profitable trading opportunities before long-term investors get the chance to act. Such trading platforms are usually provided to the general market for a monthly fee, but qualified day traders can gain free access to them by meeting monthly trading minimums. The bad news: day trading is one of the hardest professions to master. With its potential for generating very high returns, financial trading has attracted some of the smartest and most talented people in the world. Harvard sent nearly a third of its graduating class of 2008 to firms where they would work as bankers, traders, or investors. Many of these talented individuals work at institutions where they have significant capital at their disposal, and some even have branched off to form their own hedge funds. Either way, these competitors have both deep pockets and a sophisticated knowledge of the markets. Aside from the competition, retail day traders are also at the bottom of the stack when it comes to the economies of scale associated with trading. Institutional investors have large amounts of capital and place large amounts of trades, so they pay less in commissions and have access to much more sophisticated analytic tools. Retail day traders often end up paying a lot more in commissions and have access to fewer analytical tools, which place them at an immediate disadvantage competitors in the market. The high capital requirements of day trading and the tendency to use borrowed money for the trading also add more risk to being a retail day trader. Given that a minimum bankroll of $25,000 is needed to day trade, many retail day traders are putting a substantial portion of their net worth at risk. Trading on margin may increase the profit potential of smaller amounts of capital by enabling traders to borrow enough capital to cover up to half of each trade. Leverage is a double-edged sword, however, and can also accelerate one's losses if used irresponsibly. After all, by borrowing money, you are on the hook for more than the amount of capital that you possess, including interest on the borrowed funds. In its online posting titled "Day Trading, Your Dollar's at Risk," the SEC itself issued a sobering warning to would-be day traders. Be prepared to suffer severe financial losses. Day traders do not invest. Day trading is an extremely stressful and expensive full-time job. Day traders depend heavily on borrowing money or buying stock on margin. Don't believe claims of easy profit. Watch out for hot tips or expert advice from newsletters or websites. Remember that educational seminars, classes, and books about day trading may not be objective. Check out day trading firms with your state securities regulator. Day traders must overcome tremendous odds in order to generate a consistent profit in the market, and many people simply are not cut out for the job. It often takes several years for retail day traders to generate any profit, and several more years for them to generate a full-time income, assuming they can afford the early losses and eventually become proficient at the job. The industry is also becoming increasingly competitive with the rise of high-frequency trading and algorithmic trading, which facilitate capitalizing on opportunities in mere milliseconds. Minus-sum game. Day trading is often considered a minus-sum game, as retail day traders start out at a disadvantage compared to institutional traders. With the odds stacked against them, retail day traders must overcome these odds by generating higher real profits than institutional traders, while using the same information and contending with a great number of competitors. A retail day trader may make a $5,000 trade with a $10 commission and incur an immediate loss of 0.2% due to the commission, whereas an institutional trader may make a $50,000 trade with a $5 commission and incur a loss of only 0.01%. As mentioned earlier, institutional traders may have faster access to information, which could be used to gain competitive edge that goes beyond economies of scale in executing transactions. In many ways, the minus-sum game is similar to the way casinos work, in that the house takes a cut and puts all gamblers at an immediate disadvantage. While it is still possible for one to generate consistent winnings and make a full-time living by just beating out other players at the poker table, It is even easier to do so if he starts out with a lot of money and plays at higher stakes tables. It also takes more effort to earn money than it would if everyone started out at an equal footing and the casino did not take a cut. Commissions. Commissions are the single largest expense incurred by many day traders given the sheer volume of trades they execute. Often the most important consideration for day traders is the size of the trade rather than the commission amount itself. The same flat fee commission eats up a bigger chunk of smaller trades than larger trades. For this reason, retail day traders are at an immediate disadvantage compared to institutional day traders. Unfortunately, many day traders underestimate or fail to take into account these effects in their performance reviews. There are three types of commissions. Flat fee. Flat fee commissions are fixed charges for a transaction that do not take into account the number of shares being bought or sold. Percentage-based. Percentage-based commissions are variable charges based on the value of the trade, such as 1% of the trade value capped at $20. Combination. Combination commissions are a combination of the flat fee and percentage-based commissions. Commissions have trended significantly lower over time, particularly for day traders. As competition among brokers heats up and systems become increasingly automated, many online brokers are already offering traditional investors commission-free trading, a practice which could eventually spill over to the day trading market where a greater number of transactions take place. These brokers are focused on making money from a combination of interest on cash balances and margin interest on funds which day traders borrow to leverage their returns. For some brokers, it is important to make sure that trades are being executed at NBBO National Best Bid and Offer prices by receiving compensation from market makers for order flow and executing trades at less than favorable prices. The zero commission brokers of the 1990s actually cost traders a lot of money. While many of these practices no longer exist, it is still advisable to double check that low commissions are a good deal with no hidden costs. Finally, day traders should always try to negotiate lower commissions over time. The published rates on many broker websites represent their highest rates, with discounts widely available for those placing a high number of trades. In general, many brokers are willing to negotiate downward by around 20 to 30%, depending on the size of the day trader's account and the number of transactions he executes a year. These relatively small discounts can add up to a lot of money over time, so it pays to negotiate. There are also a number of different ways for day traders to reduce their commissions over time, depending on the type of commissions they are being charged. Larger trades. Placing larger trades would mean that a smaller percentage of the overall value is being paid in commissions. A trader being charged $10 to execute a $1,000 trade is paying 1% in commission, but a trader being charged $10 to execute $10,000 in a trade is paying only 0.1%, which is a lot less to make up. Fewer trades. There is no rule about how many trades day traders can or should place in a single day, but those placing a high number of trades are typically paying more in commissions than those placing a lower number of trades. Limiting the number of trades per day can help keep commissions in check. All right, I think we'll stop there. This chapter is kind of depressing. It's like clearly really giving you all of the potential negatives to day trading, which is good to know, but just reading all of the disadvantages like back to back is just, sounds a little bit discouraging, but I mean, it is true, and it is the most risky way to trade. So I guess, right, you need to know the rules of the game that you're going to play before you play it, for sure. But we'll end it right there, and we'll come back and we'll finish chapter 2, the last half of it, the next time. All right, thank you guys for joining. I'll see you next time.